Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. It was correction time across the board after China and President Trump upped the ante on their trade war. After topping $4,000 US, the price of gold might have topped. Ross looks at crude and uranium as well. Veteran trader Victor Adair joins us from Vancouver Island to chat about the state of the stock market, rare earths, trade wars, interest rates, and crude. Author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth weighs in on falling real estate prices in Vancouver and Toronto, mortgage rates, and whether we should have access to Chinese EVs. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be with you, Jim. And we've got ourselves a change in markets this week. I guess you would really look at it as maybe a pivotal week. We've got the S&P, the NASDAQ, the Russell all reversing to the downside after Trump's comments regarding China and rare earths. And, and oil, and I guess on the other side of the coin, the things as far as the Israelis and Hamas, anytime something like that, peace treaty comes about, you tend to get a reversal as well. So the technicals were in place. We had the high-grade bonds, the HYGs, and the CCCs. They double-topped here over the last 2 to 3 weeks, and as of the 8th, as of Wednesday, they started to break through support, and on Friday, they really gave up some big ground. So that type of reversal is significant enough that it's going to affect the market for quite a while. And I wouldn't be surprised that, the rest of October through November becomes really questionable on the downside right now. So, when we look at other indices like the Dow Transports, they've been in a divergent mode for quite a while, failing to put on higher highs. And they clearly have broken down. We're looking at the lowest levels since June. So there's a real Dow theory sell signal sitting out there, which is pretty significant.
Ross, I thought traditionally the Dow Transports, when they go down, they just take everything with them. Is that the case this time?
Yeah, and that could very well be the case right now. I mean, I would suspect, as I say, it's going to take weeks and maybe a couple of months to get this thing unwound right now. And, it's been a pretty big run on the S&P from roughly 4,800 to 6,800. So, gosh, if it just came back and tested the highs that we had in January, February, that would be pretty big. That'd be a big 40% correction there. And who knows? The strange things have happened, especially when you've had a run as big as this one. Also, I saw that the September had the biggest retail investor buying ever, not just recently, but ever. So you've got all these investors that have come in at the tail end of a move, and there's a lot of vulnerability when when markets start to turn. The beginning of it, they won't mind, but if it gains some momentum, then, first, second leg down can have some really big movements in it. Just think back to what happened in February. February was a big break. I had a little bounce into March, and then April was pretty rough. We got into that April 7th low. So, I'd be looking for pretty good clean out even here right now. And, when I look at things as well, like our will go, which is looking at the global G2. So that's the money supply. That doesn't show a significant low until we get out into the first week of December. And that's a good leading indicator for finding lows. It was one of the ones that was right on track in April. So, I would suspect that from a monetary aspect, right now things are not looking healthy.
What's happening with crude?
Crude oil, there we go. On the downside, you're looking at the lowest levels that we've had in a couple of months. We're under 59 as we close off the week. And, I've been thinking and talking about how we would have a seasonal break in here. So this one's on track right now. It's only the second week with a close below 4 weeks earlier. And the best bottoms historically happen when you get 9 weeks with downside action. So there's lots of potential in terms of time on the downside here. Doesn't have to be, a big magnitude, but from the period of, we're only, say, 2 weeks into it, could ideally be 9 weeks of market pressure in there. So, there's another item that puts a damper on things.
What's going on with gold after it hit $2,000 or $4,000 US?
Well, we've had a target here of 4,100, and the spot price got up there just shy of that this week. We've got upside exhaustion signals, so we take a look at the strength of trend. And coming out of this consolidation that we had through the summer, the breakout there was pretty good. As to say, our measured targets were, at 3750, 3880, and then 4100, with 4100 being the minimum upside target. So we've come within $50 of that one. But the strength of trend that we look at, it generated some pretty high numbers, and it's the type of thing we've only seen a dozen times since 1972, and we got very close to kicking in the exhaustion signal on Thursday. There might be one or two more little pushes to the upside as it gets towards 4,100, but overall, this market is setting up for a pretty good correction, and say considering how far we've gone since we broke out of the summer trading range, this is another one that clearly is ready for a correction. And if we look over at the silver market, it got up to $51, so that's all-time high. The weekly chart has got good upside exhaustion signals. And if you look at the RSI, you look at the strength of trend, the weeklies are definitely in a position for a good-sized correction. So I think if you've got any of the miners, you look at the SILJ in silver, the GDXJ over in the golds. Pretty good time to take some money off the table. It's been just an excellent run. Might as well take it while it's there.
U.S. and Canadian dollars, how are they doing?
U.S. dollars got this really nice double bottom since the July low. It broke out this week on the upside. Gave back to a little bit on Friday, but overall, that's a good-looking base, and that fits part and parcel with a gold top. So at this point, the dollar index probably can push up to the 101 to 102 level, and it's a good-looking basis, no question about that. On the other side of the coin, you've got the Canadian dollar, which has been moving to the downside, pretty much the second weakest currency out there. And there's lots of potential, I think, for action there. Usually moves with the CRB and with the crude oil market. And at this point, there's no divergences to tell you that it should do anything other than that right now.
Is there anything else we should be keeping a close eye on right now?
Yeah, well, we've been really bullish on the uranium complex, and as of this week, right into the end of the week, 8 of the stocks that we keep an eye on in that sector, out of maybe 15 stocks, 8 of them are at multi-year highs this week and continuing to move up. So even if they have a little bit of a pause, that's one sector that you clearly want to participate in. And, with all that's going on as far as the green energy is concerned, uranium's the place to be.
Ross, thank you so much for being on This Week in Money.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC. He's speaking to us from beautiful Parksville on Vancouver Island. His website, Adair.ca. Welcome back to This Week in Money.
Well, Jim, thank you. It's good to be back with you, and it has been an amazing week.
Yeah, here. Before we discuss individual markets, we'll take a look at the overall view. There's an ongoing shutdown of the U.S. government, potential changes in the governments of France and Japan, rising tensions between China and the U.S. Meanwhile, global stock indices are at or near all-time highs. Gold's trading above $4,000 U.S., silver's trading above 50, but crude has dropped below 60. Kind of interesting stuff for your thoughts here.
Yeah, believe me, and you've just touched it. It has been a pretty incredible week, but let's take a quick look at the big picture here. The S&P, which I use as my benchmark for the global stock markets, and actually I think if you add it all up, the S&P represents about 70% of the global stocks. But anyway, it's up about 40% from the lows that we had in April to the highs that we had this week. What I'm seeing generally is that as the market has gone higher and higher, speculation has become more intense. In other words, that would show up, for instance, in huge call option volumes, in stuff that we would call junkier, instead of being like the blue chip stocks, stuff that's maybe a bit fringy, things that are, somebody's idea. It's not actually making any money yet. Those things have been aggressively bid. Volatility in the market's been low. So you kind of have this background where people are just going, you just have to believe it. The stock market, it'll have a correction here or there, but it just goes up, and you've got to be in or you're going to get left behind. So there's that kind of thinking going on. That's with individual investors, and I think at all levels, certainly people who manage other people's money have got to be buying into this market or they're going to get fired. The people whose money they're managing for will move the money to somebody else. So we've also seen this incredible concentration where just more than a handful of the big cap tech stocks in the USA represent a huge proportion of the American market and really of the global market. I think in some respects we're at a bit of a the hype cycle in the AI game. I mean, hundreds of billions of dollars are being spent on rolling out data centers, that sort of thing. I think it begs the question, really, will all this money that's being spent by these firms, the big firms who were just free cash flow generating machines, and now they're making all this hard asset investment, lands and buildings and computers and so on. So the question is, will all this money that's been spent ever produce a decent return on investment? Clearly, some people think it will. Other people, like me, a little more skeptical. Another thought is, for the last couple of years, the biggest buyer in the stock market has been corporations buying back their own stock. And who's been buying back the most? Big cap tech, okay? The corporate buybacks this year, we're probably over $1 trillion in net buying. This is just from, the big cap tech stocks in the USA. If they're spending all this money on the AI rollout, call it that, will they have money left over? How much money have they got? How much free cash flow have they got to continue in their role of being the buyer, the biggest buyer in the market? I was going to say the buyer of last resort, but I canceled that idea. There's another thing that's happening. We used to call it vendor financing, or you could call it the circular financing, where somebody's buying somebody else's stuff, given that they're going to sell them something, and it goes round and round. That looks a little suspicious. But the thing I think that's really turned the dial here just happened this week, and I read about it first middle of the week, and that was China putting restrictions on the export of rare earths and things tied to that. And it didn't seem to make much of a dent, although on Thursday we had a bit of a break in the stock market, certainly had a break in the precious metals market. And then Friday morning, Trump came out in his usual style, just as retaliatory as you could imagine, basically saying he's going to hit China with massive tariffs, that they've been lying all along. He knew it, and this has just proved him right, and so on. Now, when the news hits the market, it's really important how people were positioned ahead of time. So, for instance, if there's a scheduled news event coming and people are anticipating it's going to be bullish, and it comes out, and sure enough, it's bullish, you could have some selling because, everybody had already bought. So we call that a news failure. On the other hand, if there's an anticipated news coming out and everybody's positioned for it to be bullish and it's bearish, it's like, yikes, and everybody hits the sell button. So I think this is even more important when the event is not scheduled. It's unexpected. So China unexpectedly announced these restrictions on exports of very critical minerals to the rest of the world, and in particular to the United States. And then unexpected that Donald Trump would react as much as he had. We were in an environment where Donald Trump and Xi Jinping were going to be meeting about 2 weeks from now at the OPEC meeting in South Korea, and I think the market was kind of positioned for we're going to have a kiss and make up or whatever, something like that. Now, unexpectedly, it looks like relationships between the United States and China, specifically trade and tariffs, are going to, they're banging heads. Okay, so how did the market react? Well, just, quick picture, the Dow Jones is down over 1,000 points on that kind of news. All across the board, markets had been, I think, as I'm trying to paint the picture, speculation was there, the volatility was low, people are expecting the market's just going to keep going up, everybody's got, loaded to the gills with stocks, and out of the blue, we get whacked with this piece of news, and the more I think about it, the more important I think that is, so that's probably a good place to start our discussion.
In terms of individual markets, we'll start with the metals. What do you see happening there?
Okay, like you said earlier, we've had a roaring precious metal market. Gold did trade well above $4,000, at least in the forward markets where I trade. And it's the rate of change over the past few years. You know, how long it took to go from 1,000 to 2,000, and from 2 to 3, and then 3 to 4. The time increments are shortening and shortening, and gold is, in some senses, has just gone vertical here the past few months. Silver had a really wild day on Thursday, and I think some of that, it had like a $3 range between the high and the low, and in different markets. I know in some of the markets the silver traded above $50, and others maybe not so much, but and $50 has been kind of the ceiling on gold going back to
silver.
Go back. Pardon me, silver, exactly. Go back to 1980. We touched $50 in 2011. We touched $50, and now this week we touched $50 and have reversed. So part of what's happening there, and this is clearly just my opinion, but the gold market, you know, everybody knows central banks have been buying a lot, and there's been momentum building. We've seen much more aggressive speculative activity, particularly in the Shanghai futures market that I watch very carefully. Then also look at gold shares. I've been writing about gold shares for the past couple of years, how they were so underperforming gold, and then this year gold shares have just like gone to the moon while gold is, you know, just getting going. So there's been this intense run to the upside, and clearly gold wasn't being bought just as like a safe haven or, you know, a practical hedge to balance off the rest of your portfolio and all that kind of stuff. Hell, people were buying gold because it was going up, you know, and the more it went up, the more they wanted to buy, and everybody that was in the game, virtually everybody who was in the game, was saying there's nowhere to go but up for the precious metals because of this, that, and the other thing. And the primary reason, of course, was that the governments around the world are debasing their currency, and you need to own something that's going to hold its value. Okay, so then we had our first $100, I shouldn't say first, but we had a $100 down day on Thursday, and that seemed maybe the sort of thing that you'd expect, that the volatility is going to ramp up here as the market has run up the way it has. But I think also the gold market might have had an early sniff at the seriousness of these tensions between China and the United States. I'm not sure on that. We'll see more, but we did have a down day. The market came back pretty good on Friday. Here's something that I almost like a sign I've got on my screens. Nobody wants to be short gold going into the weekend, and I think that's certainly. I don't want to be short gold. I think a lot of other people are thinking that way as well. So even though we had that hard break Thursday, the market came back pretty good on Friday. Let me give you a quick thought on copper. You know, we had copper have a real sharp run higher. I'm going to say it was in the early part of July when the let's say the Trump administration, put tariffs on copper. And it seemed as though they were going to tax anything and everything that was made out of copper coming into the country. And then on near the end of July, they said, well, that was sort of an administrative error. We didn't want to put tariffs on refined copper. And we had the price of copper traded in the COMEX drop about $1.50, I don't know, in 2 minutes. Now, this is a market that fell from $6 to $4.50, so that was a huge drop. Since that drop, and I thought that, you know, that kind of cleared the air, as it were, of rampant speculation in the copper market. The price of copper had been climbing back from those levels, from call it $4.50 back up to, certainly $5.25, that sort of thing. So copper seemed to be finding its footing, as it were. But copper had a pretty hard break late in this week as well. So I think, you know, this thinking in the market that stuff only goes up really got a challenge here on the rise in China-America tensions, and I don't think that's over.
Stock markets have been soaring, but had a bad day yesterday. Have they peaked?
Yeah, well, sure, that's the $64 question, and the easy answer is probably not. And, even though I sound a little bearish, and I have to say I'm positioned that way right here, but I mean, I also have to acknowledge the stock market has been virtually a one-way ticket, particularly since April. And you fight that at your peril, as they say in Scotland. However, Jimmy, I don't want to freak people out, but I think this ramp up in tensions between China and the United States, it has really hit this market, and the market was vulnerable because it was so overextended to the upside. There is certainly the opportunity for Trump and Xi to meet in South Korea and wrap their arms around each other, and say, hey, we're going to be the best of pals, and working together we can make the world a better place, and so on. And, the stock market would just explode to the upside, okay? So I don't think that's the way it's going to play out. I think the market here is sensing that this is a big event, and we'll see. Have they peaked? I don't know. It always depends on your time frame. I think this market is at risk of falling some more. There's what we call the systematics that trade in the market. And believe me, most of the trading that gets done these days is not being done by people. It's being done by machines. I mean, the people program the machines, but still, it's the machines. So it's almost like it's quants, and the quants don't have feelings. Okay, they just trade their math. If the market starts to go down, then these machines that are programmed to be buy, they also have, let's call it a stop loss in there. And if the market starts to go down, then they start to peel off some of the stuff they already bought. And that the opportunity for there to be substantial sales from that kind of peeling off of the systematic buying is serious money. And, I think it's a short-term peak, let's put it that way. I don't know about a long-term.
The U.S. dollar index nearly hit a 4-year low in the middle of September, but has rallied about 4% since then. What are the issues in the currency markets?
Okay, let's back up a bit. I mean, we go to the beginning of the year. The U.S. dollar had been pretty strong for the past couple of years, but there was all of this talk about American exceptionalism, has kind of run its course. It's like there's been so much money come to America for safety and opportunity, as I say. The markets are, priced for perfection. So, let's start looking for opportunity. Let's take some of that money off the table and look at opportunities elsewhere. And then there was the Trump factor. Clearly, I think when Trump was using the term 51st state, referring to Canada, there was some people, Canadians, whether I'm going to say retail or institutional, who didn't like that insult, and started taking some money out of the United States. I think the same thing was happening in Europe. We could see that. Certainly those markets maybe were overdue to have a catch-up, but, since the April lows that were made following Liberation Day, when I look at and I write about this in my blog, but the Canadian stock market, I think, has been up for something, I think it was like 29 consecutive weeks it had traded higher. So there's been this magnet of capital flowing into markets outside of the United States, even though at the equity level they've all been going higher. So currency specifically, the U.S. dollar fell about 10 to 12%, I guess, from the beginning of this year to the end of June, I think it was. And since then, it's done better. And particularly in the last few weeks, it's done quite a bit better. And part of that was people had been positioning, speculators have been positioning for a weaker U.S. dollar. The Canadian dollar, for instance, has dropped about 3 cents. And that's in an environment where the U.S. dollar was going up against everything. I've said, I think, with you earlier, that if I was trading on the basis of energy policies alone, I want to be short Europe, and I certainly want to be short the UK. Compared to the energy policies in the United States, that would be a no-brainer. But of course, there's more than just energy policies that are impacting the currency levels. I think just lately here, some of the political issues we've had in Europe, certainly as you mentioned, France, looks like there's maybe a government change there, or maybe they can't form a government. That's worrying. Germany appears to be in a recession. Their biggest export market used to be China, and China is basically saying, "Nah, we don't want your stuff anymore." And that's an exaggeration, but you get the idea. The UK seems to be floundering, so Europe's been weak. In Japan, this has been a big play. There was an unexpected win in the running for somebody to take over as the head of the LDP party, and that turned out to be, I'm going to say Takahashi, but I'm saying it wrong, and she looks to be set to be the first female prime minister in Japan. What's important about that is she is like a follower of Abe, and Abe had these policies from 2012 until let's say 2022 or so, which dramatically weakened the Japanese yen to try to get the economy and the market back up on its feet again. So the market's thinking she may follow through with that. Whatever. It's been a case of a one-way street lately for the U.S. dollar stronger, not so much because things were wonderful in the United States, but of the other countries, Europe in particular, Japan as well, were seen as maybe not such a good place to be, so they were off and the U.S. dollar was bid.
It seems that nearly all central banks have been cutting interest rates with expectations of more cuts. Do you agree with them?
That's certainly the expectation. We've been in an era here, I guess, over the past 2 years of more likely people cutting interest rates rather than raising them. And again, with the exception of Japan. Japan's been raising rates. But yeah, we had a quarter-point cut from the United States, and that was on the 17th of February. And interestingly enough, going back to what I say about how markets are positioned, that was the day that the U.S. dollar hit the lowest it's been certainly this year, I think, and has turned higher. It's amazing how this, how positioning is so important when you get these bits of news. With the interest rates, the forward market's currently pricing in the United States a very high likelihood of 2 more 25 basis point cuts this year, with another 1 or 2 coming next year. But, we'll see if things change. Those predictions, let's call it, will change as well. There's, I guess, one of the arguments is if inflation was to be low and people are losing their jobs, it's a one-way street for the central banks these days to be cutting interest rates. But then, there's other people that argue rather effectively, I think, that, there's a different paradigm here in terms of what employment is. I mean, one of the things we're seeing, for instance, especially in the United States, is productivity is rising, and let's say more work's getting done with fewer people. And perhaps that is just technology, maybe AI and whatever else. And then, of course, we have, like we had, what was it yesterday, the Bank of Canada came out and said, we gained 60,000 jobs in Canada after losing 100,000 jobs the previous 2 months. And it just kind of reinforces the problem of trying to count noses, in an economy where there's millions of people. I just can't take the government stats on something like that to be absolutely true. I don't think they're trying to lie to us. I just don't think they can do a good job of keeping track of that stuff. I would much rather have interest rates set by the market, and we've seen over the last 20 years or so the central banks have become more and more intrusive into the markets, trying to set policy and set interest rates. But just to circle back to your question, I think rates are probably going to go a little lower. Right now, the difference between Canada and the United States, American 2-year yields are about 1.1% higher than they are in Canada. That's at the margin. That's a reason for the U.S. dollar to be going up against Canada. But as I've said with you many times, the value of the Canadian dollar is much more often determined by things that are going on outside of Canada than by what's going on inside of Canada. If the price of crude oil in the world market is going down, it's also going down in Canada. That's not something that's Canada specific, but lower crude oil prices act as a drag on the Canadian dollar and that. Sorry, Jimmy, I got a bit off topic there, but I am mostly focused on the bond market. We've seen bond yields rising in Japan, the 10 years at about a 17-year high. The 30-year bond is at the all-time highs. When I look ahead and try to anticipate what bond yields will be, on the one hand, we have a trend, it seems, around the world, certainly in the United States and in Canada now, and maybe more so in other countries, where the governments want to run it hot, as they call it, with fiscal policy, and they want to lean on the monetary folks to accommodate that. So what that ultimately looks like is that we get more and more and more debt, and at some point, maybe people say, I need to be paid a lot more if I'm going to buy a bond. So yields have to go higher or I'm not going to buy it. And I think that is really the bugaboo that's troubling markets, is the rising amount of debt in the world, and is there any intention to ever paying it back fairly? And I think the easiest, maybe the most politically convenient way to deal with it is to just try to run the economy hot so that it's easier to generate the money you need to service, the debt that's outstanding. But, I think maybe that is the fundamental reason, why the gold market is rising is people are just losing confidence or faith in the governments and, the other institutions like the central banks.
The different energy markets are marching to their own drummers. Uranium prices have soared since the October lows. Oil and gas shares have not really been as strong. They've been falling the past couple of weeks. Crude oil trading below $60 this week. What are your thoughts on energy?
Yeah, I don't trade the uranium market, but it's just another one of the things I follow. In fact, the things that I trade are almost exclusively on exchange-traded futures and options contracts, and we just don't have a uranium contract. But I certainly watch it. I thought that the uranium, call it complex, the shares, have been caught up in this enthusiasm for everything that's shares. And might even be at the more speculative end of the spectrum, because I think with a lot of the companies, you're buying a dream, rather than actually like a brick of uranium. So there's been that. I've seen it. I don't trade it. I don't want to pretend I can fairly comment on it, other than it looked like it was just part of the party. On the crude oil side, I feel a little more comfortable there because I do trade it, and I have for years. We've got a supply-demand imbalance, at least in the market's mind, of how much crude is being produced and will come on stream and how much will be needed or taken off. And clearly, lately anyway, there's been a decline. Some folks might say, well, peace in the Middle East has probably contributed to that. I guess so. That's pretty hard to measure, not to imagine. I mean, certainly when there's stress in the Middle East, we call it a war risk premium. So maybe fairly, with the idea that we've got peace coming in the Middle East, that may have helped depress prices. But I think it's just much more fundamental than that. I think there's just more crude oil around than is really being demanded, and I see that not only in the current price of crude, but in the forward strip. So it's under pressure. Now, I know you talk with Joseph Schachter. Joseph's a good friend of mine. I'm going to be in Calgary next week for his major annual conference. And by the way, I love going there. One of the things I love is I learn so much, and I'm just so impressed with the technological advances that the Canadian energy industry has developed and is using. And you see the price of crude oil here. Let's call it $60, And I remember crude oil was $30 in the 80s. So sort of just on a basis of inflation-adjusted prices, we should probably be over $100 on crude oil. But it's technology that's kept the prices down because they're able to develop and get out of the ground and deliver much more than they could have been expected to do back then. Anyway, crude, I think that's really the issues here. I am right now much more focused on currencies, stocks, and interest rates and the precious metals, and I just kind of watch crude out of the corner of my eye. So I'm sure I'm missing something, but I think that's really at the heart of it.
Before we wrap up, do you have any parting thoughts for our listeners?
Well, if I've got a theme, Jimmy, I guess it's something like, risk assets became an easy way to make money, whether it was, stocks in particular and even the more speculative end of the stock market. And I think that's been overdone. Now, you asked me earlier, have we made the peak in the stock market? I don't know. It certainly seems like this has been a pretty impactful correction here that we had at the end of the week. That I would say it this way. I think it's always a good idea for people to have a look at what they're invested in and say, I got into this because I was thinking such and such. Does that still apply? My plans are that I want to do this and that, and is the way that I'm invested right now, does that make sense, or should I make some changes? Should I take some money off the table? Should I become a little more cautious rather than more aggressive? Is this dip another great buying opportunity or a sign of something to come? You never buy the lows and sell the highs. And usually, in terms of sentiment, things are never as good as people think they are at the highs, and they're never as bad as they think they are when the market's making lows. But, if you can just, let me sum it up this way. As a trader, my job is to try to make money, managing my risks and having my ideas and all that. But the other part of it is, and hang on to it. And man, oh man, in my career, I just saw so many people who would, make money, but ultimately end up with less than they had started with, and usually because they just found it so darn hard to sell something, whether they're selling it at, because it's down or now it's in a loss, whatever. It's kind of like, well, let's just give it a little more time. I'm sure it's going to turn around. So, you got to live with the reality in a mark-to-market world. Your expectations will get you into something, but they can also maybe keep you into something far longer than you should be.
Victor, thank you so much for being on This Week in Money.
Jim, it is always a pleasure to talk with you. Thank you.
My guest has been Victor Adair, his website, Adair.Ca. Coming up, Hilliard MacBeth, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. He's speaking to us from Edmonton. Welcome back to This Week in Money.
Nice to be on again.
Hilliard, can you tell us about the second edition of your book, and would this be a good time for people to check it out, and where can people buy it?
Yeah, so it's called When the Bubble Burst, Surviving the Canadian Real Estate Crash. And of course, now we're into the survival mode, I think, and that there's a lot in there about not just the bubble, but also how to avoid getting caught in the aftermath of the bursting of the bubble, which is where we're starting to head now. So it's very timely, and it can be bought at all the best bookstores or online with Kindle or the other ebook offerings.
In your book, When the Bubble Bursts, what happens after sales dry up?
So when the sales dry up, what happens is there's a period, sometimes months, even a year, where the sellers still have their anchor price in mind that they don't want to budge from. But the buyers are more savvy, and they're aware that the prices have come down, as in Toronto, 20, 25, 30% in some cases, and they're not willing to pay any more than the new discounted price. So there's a gap, and that basically means that there's no activity. And, of course, the trigger to wait for to get that resolved is when the lenders, the banks, or a lot of these shadow bankers are now getting caught, and they trigger the sales themselves. They get the legal power foreclosure or power sale, and they push the sales, and they don't care. They just say get rid of it for whatever, and they're not holding out for some special price that they had in their mind. They just want it. They just want it gone, and so that's when you really start to see the bargains. So we're not quite there yet, but it's coming soon.
What's the latest on Canadian home sales, inventory, and pricing, especially Greater Toronto, Metro Vancouver, and other major cities?
So Toronto's where the biggest problems are, and if you have in terms of problem being a drop in prices. Now, for some people, that's a good thing, right? So, but for the people that are stuck with huge mortgage debt, that's very traumatic. And there's, the Toronto Real Estate Board has many different prices, so it's hard to tell exactly what's going on. But anywhere from 15 to 30% drop in sort of the average price in the low-rise segment. And in the high-rise segment, the condos, it's catastrophe. Like it's Armageddon. There's tons and tons of thousands and thousands of new units coming on stream almost daily from the buildings that were started 3 or 4 years ago, before all this started to happen. And then there's all the investor owners of condos that are maybe 5 or 10 years old that are finding they can't rent them out anymore for the price they want, or the price they need, I should say. And so they want to sell rather than lose money every month with tenants that don't want to pay. And so that's just a very difficult situation. There's very, very few buyers, and people see the writing on the wall. Articles in the newspapers talk about it, which is new. For a long time, no newspaper would publish anything about a weak housing market, but now they're starting to talk about the condo market, and so buyers are almost non-existent. And in Vancouver, we're starting to see the same thing with an excessive amount of condos. And I was there in July and walked around downtown, and every single apartment seems to have a vacancy sign out, and we can see that the condo prices are starting to slip. So rents are coming down all over Canada. That's the alternative. I mean, if your rents are coming down, maybe you don't need to rush out and buy anything right away. And so in smaller centers like Edmonton, Calgary, Montreal, it's a mixed bag. Prices have actually gone up in Quebec, and they're sort of holding steady in Calgary. They started to come down a little bit in Edmonton. They never really went up that much. Prices in the neighborhood I live in Edmonton are about the same as they were 2007. So what's that, 18 years ago? And so with inflation being 2 or 3% a year, prices are much, much lower adjusted for inflation than they were in 2007. But nominally, they're about the same, maybe slightly higher. So it's all about the debt, the amount of debt that these properties are carrying, and that's what's knocking it down.
Did they build too many condos of the wrong kind? They're all very tiny 500 square foot units.
Yeah, those buildings were designed and sold to investors only. They weren't really sold to families. No family would want a condo. It's one guy in Toronto calls it a dog crate condo. Nobody wants that. But investors would buy them, and then they'd rent them out to single students or whatever, unemployed people. I don't know who would pay rent, but certainly no families. And as soon as people start to think about having children or growing the family, of course, they got to get out of that situation. So, yeah, they're having real trouble with those. They didn't build the right kind of housing. And if you go back to the 1960s, 1970s, 1950s, it was basically a function of governments getting involved in getting the right kind of housing for families built after the Second World War, and then through the CMHC and that caused the boom in housing that basically housed very cheaply all of the baby boomer families, huge families, average of 3 or 4 kids per family, and that worked really well up until about the 70s and early 80s, and then housing became an asset, and people started buying it as an investment rather than as just a place to live, and everything's kind of gone sideways since then. The banks got really heavily involved in lending to speculate in housing and buy bigger housing, and the developers built the wrong kind of housing. So that's where we're at now. I often think, why don't somebody buy 2 or 3 500 square foot units and knock the walls down and have a nice 2-bedroom? But it's not quite that simple, of course. But something like that is probably coming.
And also in BC, we have a shortage of hotel rooms in Vancouver. I think a lot of people thought these little cracker box condos would be perfect for Airbnbs, and the government has basically banned that business now out of the blue. They weren't given any warning. So I think a lot of people have lost money there.
Yeah, the Airbnb thing is quite interesting. You know, like a lot of people, though, they like having a bigger place than a 500 square foot condo in the Airbnb game, and I don't know. It's really, really a complicated situation. But what we know is probably once all of the speculation and all the investing and all of the trading, which used to go on, gets removed, and it's pretty much gone by now, I think. We'll find out that we don't have the shortage of housing that we thought we had. You know, a lot of that stuff was being held off the market by investors and speculators and money launderers and people like that. And when you get right down to the families that need a place to live, we'll probably find out that there's adequate supply. The only thing would be in the large family segment where you've got, you know, a mom, dad, several kids, maybe a grandma or grandpa. That there's probably a shortage in that category because that just did not get built. But other than that, I think things will work pretty well once we remove all of the speculation and the flipping. Do you remember flipping? Like people had books on how to flip in the real estate market, right? I don't know how that's working out now. I don't think it's more like a flop, how to flop in the real estate market.
Do housing crashes usually affect stock markets or vice versa?
So the common link between the two is the what I mentioned already is the debt. And the stock market and the housing market are very different animals, though, different participants. But the debt is what will link them together. So if a housing bubble bursts, and that causes a bunch of the lenders, especially in Canada, the 3 big banks plus the other banks, to get into trouble with loan losses, then that drags the financial sector down on the stock market. And in Canada, it's the biggest sector by far in the stock market. It's like, I haven't looked at it for a while, but it could be as much as 35% of the value of the stock market. Then the whole stock market will get dragged down because that's just too big a segment to ignore. But then that leads to a recession because you can't have a major housing slump without a recession. It just never happens. So you got a stock market dragged down by the financial sector. Then you got a recession, which is caused by the housing bubble bursting. And then of course, then you get the rest of the stock market gets dragged down too. In the U.S., it's a little different because the financial sector in the U.S. on the stock market is not nearly as big because you've got AI and all the technology stocks and that sort of thing. So in theory, you could see a stock market surviving a housing crash in the U.S., but of course we know in 2009 it didn't survive at all because, again, the linkage was through the Wall Street banks who got into, they had to be massively bailed out, and some of them, like Lehman Brothers, collapsed, and so that just set shockwaves through the stock market, and stock market came down 60% in just about a year and a half. So, yeah, they generally do go together, but there's no, the link is indirect, but it's still very much linked. If you can have a stock market correction without a recession, then you don't need to affect the housing market at all. But the next stock market correction probably would almost certainly include a recession because it's been so long since we had a recession. So in that case, if a stock market correction and a recession, therefore they'll get into trouble with housing as well.
The Bank of Canada and the Fed both lowered their bank rates by a quarter point in September. Do you think this will have much effect on the economies?
No, it isn't going to really. First of all, the bank rate is only an official rate at the Bank of Canada. Almost nobody borrows ever at that rate. It's like a symbolic rate, if you like. The real rate that matters is the government bond rate, the 5-year, the 1-year, the Treasury bill, that sort of thing. And in Canada, we have GICs. And so just because the Bank of Canada cuts the rate a quarter of a point, it's more of a symbolic kind of hint that the Bank of Canada would like to see rates come down. Maybe it's a hint that the Bank of Canada sees a recession coming. I don't know. But, we've talked in the past about how we might even be in a recession already if you calculate the numbers just a little bit more accurately. But yeah, no, it's not going to help the economy or the stock market just by itself. And if they cut at the next meeting, they cut a half a point, a full 50 basis points, and that'll probably push the economy and the stock market lower initially because it'll be a sign that the government's very worried about the economy. And that has a psychological effect on investors and people that make business decisions.
What's the bond market predicting for mortgage rates?
Well, mortgage rates are probably coming down a little bit because of the likelihood of a slower economy or the reality, I guess, of the slower economy. The inflation rate has not come down much, though, so it's hard to imagine bond rates coming down a whole lot more because, if the inflation rate's 3% and bond rates are between 3 and 4%, there's not a whole lot of room there. The bond rates shouldn't come down below the rate of inflation. And generally they don't. So there isn't a whole lot of room for the bond, either the government bond or the corporate bonds, or the bond market in general. Pretty hard for it to go a whole lot lower unless we get a recession. Then you'd have lower inflation, you'd have lower interest rates, lower bond rates. But that would be, but that's not where we're at. We're not at a point now where people recognize that as a likely outcome in the immediate future.
Is the velocity of money an indicator of where stock markets, real estate markets, and the economy are headed?
Yeah, I don't think so. I mean, the velocity of money, so you've got your money supply, and Milton Friedman talked about money supply being the only thing that mattered. And of course, that's not true because you can have the same amount of money, but if it's turning over at 50% faster than it was before, which is what the velocity is about, then you could have an overheated economy, even though the money supply hasn't grown at all. It's just been whipped around through the system faster. And so the velocity of money and the money supply, you have to take the two together. And it has been pretty amazing in the U.S. how much fiscal impulse from government deficits. I mean, the government deficits in the U.S. are 6-7%. In Canada here, we're worried that the government deficit, the federal government deficit anyway, might go up to 3%. Like we're less than half of what the U.S. is. And the U.S. doesn't appear to be worried about it at all. So, but it can still, even that amount of impulse from the fiscal, and you could argue the monetary side as well, could could not have the impact you'd expect if the velocity of money started to shrink and go slower. So I don't think that's happened yet, but we're looking at a very, very unusual situation in the U.S. and in Canada, but especially in the U.S. With things happening that normally don't. So the normal relationships between velocity, money supply, and the growth of the economy or the stock market are kind of broken right now. I think we'll get back to the more normal situation, but right now we can't even see normal from here. We're so far away from normal.
The TSX, the TSX Venture, the Dow, the S&P 500, NASDAQ, and the Russell 2000 and 3000s have all been hitting new all-time highs, but now we're in October. Any concerns?
Well, September and October are considered the worst months. Usually, actually, everybody thinks it's October, but actually it's September that's normally the worst month. We had a great September in the stock market, so it didn't follow the pattern at all. October is where you get the big. 1929 was in October. 1987 was in October. Lots of the one in the bottom in 2002 from the bear market that started in 2000 when the dot-com bubble peaked and started to burst. Those are all in October. But the reason October is better than September is because usually after that final sell-off in October, then it starts to recover. So by the end of October, things are looking up again. So, but this isn't a normal September, October situation. So we don't know what could happen in November. Normally by November, December, you start to get a rally because of the sell-off in September, October. Well, we haven't had the sell-off yet, so we can't predict a rally for November, December. So, no, I think whatever's coming is going to be quite unusual, and so we probably have to, the history books will have to make a little asterisk beside 2025. They'll say, well, it didn't follow the pattern because, that's probably what we're looking at right now.
Gold hit $4,000 US an ounce this week. What are your thoughts on that precious metal?
So you and I've talked many times over the past few episodes, if not years, about gold, and I've always liked it, and I preferred the gold mining stocks over the price of gold itself. But gold has done extremely well. Silver, some of the other ones are doing extremely well, and it's a sign that people are losing faith in the U.S. dollar primarily, because almost like the $4,000 an ounce that you quote is in U.S. dollars. So you could quote it in Canadian dollars, you could quote it in anything you wanted to quote it in, but almost always quoted in U.S. dollars. And in U.S. dollars, so it hit a peak in 1980, and it was $850, and now it's over $4,000. So it's gone way past the peak, even after adjusting for inflation. So it had to get to about 3,200 for adjusted for inflation to hit a new real price equal to 1980, and now it's well above that. It's 25% above that. So there's nothing really holding gold back because it's not bought for like an oil. It's not bought like oil or copper or whatever to be used. It's bought as an investment or as a store of value, and therefore, it's all dependent on that opinion about what the future value is going to be. And so, in a bull market like this for gold, there's nothing really holding it back. There is a circumstance where gold gets really crazy, and that's when people start getting so concerned about their bank account and their fiat money, as they call it, and they decide they got to put it all into gold and put it in their safety deposit box or bury it in the backyard or something. And that got so bad in the 1930s during the Great Depression that the government had to pass a law that it was illegal for individuals to own gold. That's how bad it got. Because once we talked a minute ago about the velocity of money. Well, if you put your money in gold, the velocity of the money supply, it basically goes to zero because there's no trading. There's no gold stored in the backyard in a deep hole is not contributing at all to the economy. And that's why in the 1930s, the government of the U.S. Banned the ownership of it because they didn't want people withdrawing their money from the financial system where it could be circulated and putting it into the ground where it cannot be circulated. So that's where gold could get crazy. And then you'd probably see governments stepping in again like they did in the 1930s, because it could lead to it's been so long since we've seen that it's hard to imagine. But that's where you get a debt deflationary spiral. And if anybody wants to learn about that, the classic paper on that is by Irving Fisher. It's called Debt Deflationary something. Anyway, just look up Irving Fisher. He's also famous. This guy is also famous for saying just before the October 1929 crash that something like, I'm paraphrasing now, stocks have hit a permanently high plateau and are not likely to fall from here, or something like that. So he's famous for those two things.
Silver keeps hitting new highs. Where do you think silver could go from here?
Well, I don't really follow silver. The difference between silver and gold is big, because everybody gets excited about silver when gold goes up this fast, because it's cheaper, right? It's not $4,000; it's $40 or whatever it is. But in reality, there's a flaw in silver compared to gold, and that is that central banks are buying gold. Some central banks all over the world, except Canada, are buying gold as part of their official reserves. Well, silver is never going to be part of the official reserves of the central banks. The central banks control the reserves, the financial reserves in the world economy. And if they decide they want to hold gold as a significant portion of their reserves, then that puts a real heavy bid into gold. And it's never going to be there for silver. So I would encourage everybody to look first to gold and gold mining stocks as well.
Should the Canadian government be piling up on gold again?
They don't have to. I mean, everybody's criticizing them for having sold their gold, and that's certainly, in hindsight, looks to be a big mistake. But the difference with Canada is we got a lot of gold mines in Canada, and one of the negatives of investing in gold mining companies versus gold is gold mining companies. Gold deposits are rare all over the world. There's very few of them, and so if you get a good one, like there's several in Canada. Agnico Eagle Mines has got one really good one, or several really good ones. The government could tax it. They could say, well, you guys, because gold has gone to $4,000 or $5,000 or $10,000 an ounce or whatever, you guys are making these massive excess profits, and we're going to put a tax on excess profits coming from gold mines. So the Canadian government is in a good position, because we've got more than our share of gold mines in Canada. So they probably were thinking that they didn't need the actual reserves in gold like the other countries did. That kind of makes sense, I guess. So that's the danger with. But the reality is the gold reserves, the central bank involvement is a big positive for gold price. Unless they decided to get rid of them like Canada did, but it's very unlikely that the U.S., China, France, these are all big holders of gold. It's very unlikely they're going to sell their gold reserve, their physical gold anytime soon.
There seems to be more and more bad news coming out about big pharma. Could the big pharma sector be heading for a bear market?
So the big pharma sector has been in a bear market in relation to the AI and the other technology parts of the stock market. So the big pharma sector is the most oversold sector in the S&P 500 right now. And so I would, from my point of view, being a value investor, I would be looking at it as a place to buy rather than to sell. So it's quite cheap. The negatives are pretty serious. I mean, President Trump's trying to get the price of prescriptions down, and he's proposed several different things for them to do. I don't know if any of it will ever happen, but the other guy, RFK Jr., is very much against prescriptions. He's trying to take down Tylenol. Now, Tylenol is generic, so there's not much, big impact on any pharma companies by bashing Tylenol. But yeah, no, the stocks are very, very cheap. So I wouldn't think it could stay cheap for another year or two. But sooner or later, one of them will find a cure for cancer or a cure for Alzheimer's something like this thing with Ozempic and weight loss drugs. That Novo Nordisk company, European company, went up, I don't know, 100-fold or something because of that, just that one thing. And now there's Lilly has a competitive drug, and some other companies are getting involved in it. So there's always something. It's just a little tricky finding the ones that are going to hit the lottery.
Market sectors rotate in and out of favor. Are you watching any sectors that have recently bottomed?
Yeah, that's the one. Like pharma is the one that's very, very cheap in relation to the other. The problem with the stock market, so people want to describe the stock market between 1999, 2000, and 2025 as being comparable. And if you look at the leaders in the stock market, it's quite comparable. Like the 40 times earnings, that sort of thing. It's similar to different ways to measure earnings, but very, very similar valuations as to the peak in 2000, March of 2000. In the U.S. market, even similar companies, the AI boom today versus the internet.com boom in 2000, quite similar. And some of these companies like Microsoft is one of the leading stocks then, and it's one of the leading stocks again today. And Amazon was the leading stock back then. It was much smaller, and today it's one of the Magnificent Seven. So very similar. And Amazon, by the way, went down more than 90% after the market started to correct in 2000. And some of the stocks in today's Mag 7 will probably go down by that magnitude this time around when the bear market comes. But the difference between today and then is, getting back to your question, is back then, things like mining stocks and gold stocks and bank stocks and pharma stocks and all those other boring sectors were extremely cheap. So you had this one sector, the technology.com sector, that was extremely expensive. And you had all these other companies that were extremely cheap. Because I owned them at the time. I wouldn't touch the Nortel networks because it was too expensive. And I watched the whole thing. So my clients told me, wow, how come you don't own more of that Nortel? And I said, well, it's way too expensive. Anyway, there was a place to hide in 2000 is what I'm trying to say. And today, there's very, very few places to hide in the market. There's no real cheapness to the overall market. I saw a thing today that said, well, you should buy small cap stocks. So they're not quite as expensive as large cap stocks, but that doesn't make really any sense because when the big stocks like Nvidia and Microsoft and Apple, when they correct, it's going to hit the small cap stocks as well. The other option would be just to go into something like bonds or gold, and that's probably a better option than just trying to find a cheap part of the stock market. You have to always own stocks, I think, in my opinion, but you just want to own less of them at times like today when things are so expensive.
A number of companies in Canada fired workers and replaced them with temporary foreign workers subsidized by the government. People are waking up to this, talking about boycotting these companies. Do you think those companies deserve to be boycotted?
So, it's a little unfair to those companies. I have a friend who owns a Subway. He actually owns several Subway franchises. And if it hadn't been for those temporary foreign workers, there was a guy back then who worked for the Harper government who was trying to bring in a policy to stop these foreign workers coming in. So that was, 2014 or something. And all of these guys that own McDonald's and Subways and all these little fast food operations were up in arms because they didn't have any employees. If they basically, these were the only people they could find to work. And of course, maybe they should pay more. But even if they paid more, the argument I heard was we just cannot find local Canadian people to work in these stores. So we need these immigrant workers. Where the abuses were more to do with some of the colleges that would give people a temporary foreign status, whether it be as a worker or as a student. And people just paid these fees to these colleges to get that permit, and then it was like a scam basically. And then there's other people who were doing some similar scams with employment as well. So certainly they should be going after the people that did the scam part of it. But there was a legitimate part of it where we were really short of actual real workers. And the U.S. is probably going to find this out. I mean, in the U.S., this immigration thing, there's over 2 million people, undocumented workers in the U.S., probably a lot of them from Latin America, Mexico, and other countries, that have voluntarily deported themselves. We're not waiting for ICE to come in and arrest them, but just left. And they, that's, if the workforce is, say, 200 million people in the U.S., it's probably a pretty close guess. That's 1% of the workforce. That's crazy. Like they're going to, and these people are willing to do jobs that regular people that were born in the U.S. probably can't do. And, like manual labor in the hot sun in a fruit orchard or something like that. People are just they wouldn't want to do it in a million years, but even if they wanted to do it, they probably could not work 10 hours straight and, bent over in that position. We've lost that ability. So we have to be careful about cracking down on this because, we need, to a certain extent, we need those people in both Canada and the U.S.
Canada is crumbling, healthcare collapsing, massive migration, some say replacement migration, increasing crime, more corruption than you can imagine, bills C2, C8, C9 to take away the rights of Canadians, massive debt spending lots of money or sending lots of money to other countries instead of helping Canadians that need this. Some say this is being done by design. What needs to be done to Canada to get it back on track?
Well, I don't think there's a grand design. Honestly, to me, having over a long career met some of the people in top positions, like the idea of all these people getting together and coming up with a grand plan is pretty far fetched because a lot of them just aren't that smart. And but even if they were, it would be very difficult to get everybody on the same page. So I don't think it was any great conspiracy. But what did happen though, and I write about it in my books, I guess, is the incentives. The incentives were skewed in Canada to reward people that speculated in the real estate market or that took on more debt. The lenders were incentivized to give people more and more mortgage credit, more and more HELOC credit, more and more credit card credit, any kind of auto loan credit. There's a big story breaking in the U.S. It started about Monday or Tuesday of this week about auto loans. A company that was extremely exposed to high risk auto loans has now gone bankrupt, and turns out that Jefferies Financial, which is it's a medium-sized financial company, and UBS, which is a very big financial company, were both heavily exposed to the paper that was originated by these people that were trading in high risk auto loans. And everybody knows somebody who bought a car that got a 17% interest rate loan and was negative on their previous car, and the dealer upgraded them to a bigger, more expensive car by giving them a bigger loan. And I thought, how is that possible? Well, what happened was the paper, the loan, the asset would be the note saying, I promise to pay you back for this car, was sold on to somebody else who didn't even look at the situation. And now it's turning out that this thing was all flaky and in a bubble. So that's a type of thing that, and it isn't just Canada, but it's all over the world. But Canada seems to have especially gotten heavily, like Australia. Australia and Canada seem to me are the two, after researching several books, I'd say Canada and Australia are the two in the world that got most carried away. And the common denominator between Canada and Australia is a very concentrated banking system. In Canada, it's 5, and in Australia, it's 3. And so the way these banks work is they just look at what the other banks are doing and say, well, if the Royal Bank can do it, I guess it's safe for us to do it. They have no idea what's safe or not safe. the regulators are sort of looking at this saying, well, these bank people, they're really smart and they make billions of dollars in profit every year. Who are we to suggest to them that maybe they shouldn't be doing this? So there's nobody really minding the store. And to me, that's the big issue, not some of these other things that you mentioned in your question, but how are we going to get out of this situation where we have an economy built on debt and speculation rather than real activity? And of course, in Canada and Australia also, we've got the additional burden of having been very lucky to have these natural resources that we don't actually have to do very much work. Like we don't have to. We just dig it out of the ground and sell it to the U.S. or China or somebody, and get paid very well for it. And so that made us, I guess, a little bit lazy, a little bit soft. And I don't know how we get off of that, but we need to get off of it and move on to something more productive.
Canada is under heavy influence from outside entities, including the World Economic Forum and the Chinese Communist Party. The U.S. Articles of Confederation include a provision to expand the U.S. to include Canada. Could Canada be looking at a choice here to be part of something big, the U.S., or be economically and socially destroyed?
Well, I mean, the big thing is Canada's kind of on a hot spot here because I can't answer about the question, some of the other questions, but I could give you one example. So the auto industry. So the auto industry is very important to Ontario. Millions of jobs between manufacturing and auto parts, and it's all part of the NAFTA, which used to be the Free Trade Agreement, which used to be the Auto Pact, it's called, 1962 or something. And back and forth between Detroit and Windsor and all around there, Canada and the U.S. cooperated on this auto, and Canada produced way more autos than we could buy ourselves. We had to ship them to the U.S. And so now what happened was Biden in the U.S. put a 100% tariff on Chinese autos because Chinese autos are cheaper and better than what Detroit is making. So Canada had to put 100% tariff on Chinese autos because the U.S. insisted that we do that. And if we wanted to remain in agreement with the U.S., we were forced to do that, and also to protect our own automakers. But in reality, the Chinese automobiles are cheaper, much cheaper, and better. They're electric, which is better than gasoline. They've got more technology, and they're cheaper. So all over the world, people are starting to buy these Chinese vehicles. And in North America, here we are. So we either side with the U.S. and miss out on a whole bunch of the advances that the Chinese people, leaving the politics aside, because the U.S. doesn't have perfect politics either, right? So the CCP versus whatever it is that's going on in the U.S., you could say it's right wing, left wing, but in reality, you could also say the Chinese have actually been doing quite a bit better than the Americans the last few, maybe decade or two. And so we might have to choose. And I've always said that we don't really have a choice. We have to pick the Americans over anybody else because of the proximity and the entanglement between the two countries. However, with this latest thing about, as you mentioned, the Constitution, the Monroe Doctrine, which says that eventually Canada and Mexico and these countries would probably become part of the United States of America, the greater America. It's sort of an opportunity for us to consider other options. But I can't imagine us going under the Chinese system either. So I guess ideally what we want to do is remain independent, but it's going to get tougher.
In 2009, Stephen Harper's late finance minister, Jim Flaherty, made bank bail-ins legal in Canada. Are securities in Canada protected, or could they also be bailed in if financial institutions are in trouble?
So if you go back to the 1930s, the banks all had this thing. If you were a shareholder of a bank, it wasn't a limited liability company. So there was no limit to your liability. If the bank went under, then you could, in theory, they could come after you the depositors could come after you for a cash call to help them. And of course, the Reformation in the 1930s, the banks were all closed, and then the New Deal came in under Roosevelt and that sort of thing. They brought in new legislation. They brought in a very important act, which restricted what banks could do and couldn't do and that sort of thing. So, then they became entities where basically the backstop was the government, not the shareholders of the bank anymore. The owners of the bank weren't the backstop anymore. Now, then it became the government was the backstop. And then in 2007, we had all those failures of the banks, and the governments all over the world had to pay trillions of dollars in bailing out all these banks, because the option was, they were told, was that the world economy would go into a deep depression, so they decided to bail out all these banks. So then they said, well, people that own securities that lend money to banks could be liable for a cash call, if you like, a bail-in, if the bank goes under. And for instance, a good example is in Canada, you've got these preferred shares that the banks issue. So you loan money to the bank by buying these $25 preferred shares. But in there, it's some of them, not all of them, but some of them. And the bonds also have a clause that says, in the event that the bank's balance sheet drops below a certain safe standard to do with the amount of equity they have in their balance sheet, then these preferred shares and bonds would be converted into common shares. And so that's kind of a bail-in for investors. And in the reality, I don't know if you'd ever see a government invoke that clause. In the 2009 debacle, depositors were protected up to 100,000 in Canada, 250,000 in the US. I think I forget exactly the numbers. But in reality, what happened was 100% of the deposits, including the deposits of $10 million and $100 million, were all backstopped by the government, because they realized that if they didn't do that in Canada, for example, all the money would leave Canada out of the banks, get transferred out, and move to other banks in Britain and the U.S. where they were doing that. So basically, so in theory, you could be exposed to some kind of a bail-in or a cash call type thing, especially if you're an investor in the banks. But in reality, I don't think they would actually invoke it. But having said that, though, I've always been careful not to buy those securities that have that provision. so you never know what a future government is going to do, right? So why buy them, And especially in Canada now, when this real estate bubble bursting is a reality that's unfolding, this would be one way to avoid exposure, would be to stay away from investing in securities of banks that are likely to lose quite a bit of money when people start defaulting on their mortgages.
Are used electric vehicles depreciating faster than ICE vehicles, and do you think they could be a good buy?
Well, so just for fun, I checked my used 2021 Tesla for the current price, and it was interesting because there's you can go on the Tesla website and send them the thing, and literally, and I think it was 30 seconds later, I got an answer back saying, your car, for a trade-in, we would give you this much money. And it was less than half of what I paid for 4 years ago. So I'd say in that case, now I bought the Plaid version, which is the high performance, super expensive one. And so I lost a lot of money. And yes, in that case, yes, the prices of electric cars. Now, it isn't necessarily that they're depreciating a lot faster. It's that the new ones coming out are better and better. So the 2024 Model 3, for example, which costs a year ago, cost about $62,000 in Canada, is a much better car than the Model 3 from 2018, which cost $80,000. So each time the electric cars come out, they drop the price substantially, and I think that's more the reason. And then, of course, we've already talked about these Chinese cars that they're not coming into Canada because of 100% tariff, but eventually they're going to have an impact on everything all over the world, and that is lower prices, better cars. So Yes, they're depreciating quite quickly, and if you can get your head around, the cost, if the battery fails in an electric car, it is probably much more expensive than if the engine fails in a combustion car. But set that aside. It's much cheaper to operate a used electric car than it is to operate an ICE car. And there's way fewer parts to fail in an electric car, other than it's just that one thing, the battery, which is big. But the cost of batteries is coming down very quickly as well. So I would think that even the replacement of the first Tesla I bought, which was in 2016, they said the battery was worth $40,000. Now, the new batteries of similar size, which are better batteries now than they were in 2016, it's only 8 years ago, are probably costing about $20,000, about half of what they were in 2016. So soon they'll be at $10,000. BYD, a Chinese company, sells a Seagull. It's one of the best-selling electric cars in the world, similar to Tesla Model 3 or Model Y. And they can sell those things for under $20,000 and they have a decent battery in them. So the battery cost is the big thing. So that's what's coming down very quickly, and that's why used electric cars are cheaper, because the new alternatives are also cheaper. Why would somebody not buy a new one if they could get it for the same price as a used one? So the used price has to come down faster.
Where can people follow you, and where can they buy your book?
So I'm active on X, formerly Twitter, at HMACBE, and I've also gone onto the Blue site. Blue, I can't even remember what it's called. I don't do a whole lot on there. And I have a weekend note which comes out Fridays, and this week it'll be on the pipeline, which pipeline is best for Canada. Usually it's a topic like that. Sometimes on the stock market, things like that. And people can just email at our website and say, sign me up for the thing, or go on the Twitter, X, and reply to the tweet and get signed up that way. So there's a link in the replies to the original tweet. There's a link, because Elon Musk downgrades your exposure if you put the link in the main tweet. I don't have a resentment about that, but I don't fully understand it. Anyway, you can link that and click the link, and then there's a sign-up option there as well. And I would encourage people, though, just to add one more, I'd encourage people to read the book now, because it's become very timely, more timely than it was in 2018 when it first came out.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.